Welcome to our exploration of information asymmetry in markets. Imagine entering a marketplace where some participants know more than others. This imbalance can shape decisions, prices, and even the overall efficiency of the market. In this video, we'll uncover what information asymmetry means, why it matters, and how it influences everyday transactions. From used cars to financial investments, information gaps are everywhere. Let's start by understanding the basics and setting the stage for a deeper dive into this fascinating economic concept. Information asymmetry occurs when one party in a transaction has more or better information than the other. This can lead to an uneven playing field, where the more informed party can make better decisions or even take advantage of the less informed. Think about buying a used car. The seller knows the car's history, but the buyer may not. This simple example highlights how information gaps can affect trust and outcomes in markets. The idea of information asymmetry gained prominence in the 1970s, thanks to economists like George Akerlof. His famous paper, The Market for Lemons, used the used car market to illustrate how information gaps can lead to market failures. Since then, the concept has become central to understanding how markets function and why they sometimes break down. Information asymmetry isn't just an academic concept, it's present in our daily lives. When you buy insurance, the company doesn't know as much about your habits as you do. When you invest in stocks, you may not have the same insights as company insiders. These everyday examples show how information gaps can influence decisions and outcomes for both individuals and businesses. One major consequence of information asymmetry is adverse selection. This happens when one party uses their informational advantage to select against the other. For example, in health insurance, people who know they are likely to need medical care are more likely to buy insurance, while healthier individuals may opt out. This can drive up costs and reduce the effectiveness of the market. Another key effect is moral hazard. This occurs when one party takes more risks because they do not bear the full consequences, often due to information gaps. For instance, after buying insurance, a person might take less care to avoid accidents, knowing the insurer will cover the costs. Moral hazard can lead to higher costs and inefficiencies in markets. Used car market is a classic example of information asymmetry. Sellers know the true condition of their cars while buyers may only see the surface. This can lead to distrust and lower prices as buyers fear getting a lemon. Over time, good cars may leave the market, leaving only poor quality vehicles, a phenomenon known as the lemons problem. Financial markets, information asymmetry can have major impacts. Investors may not have access to the same information as company executives, leading to mispricing of stocks or bonds. This can result in inefficient allocation of resources and even financial crises if unchecked. Transparency and regulation are often used to address these issues. Insurance markets are particularly vulnerable to information asymmetry. Customers know more about their health or driving habits than insurers do. This can lead to adverse selection, where only high-risk individuals buy insurance, and moral hazard, where insured people take more risks. Both effects can drive up premiums and reduce market efficiency. Labor markets, employers may not know as much about a job candidate's abilities as the candidate does. This can lead to mismatches where overqualified or underqualified individuals are hired. Employers use resumes, interviews, and references to reduce information gaps, but perfect information is rarely available. In buying or selling property, information asymmetry can play a big role. Sellers may know about hidden issues with a house while buyers rely on inspections and disclosures. This can lead to mistrust and lengthy negotiations. Regulations often require full disclosure to help balance the information between parties. Information asymmetry can reduce market efficiency. When some participants have more information, resources may not be allocated to their best use. This can lead to higher prices, lower quality, and even market failure. Efficient markets rely on equal access to information for all participants. Signaling is one way to address information asymmetry. In job markets, for example, candidates use degrees or certifications to signal their abilities to employers. These signals help reduce uncertainty and allow employers to make better hiring decisions, even if they can't observe every skill directly. Screening is another tool used to reduce information asymmetry. Employers might use tests or probation periods to learn more about candidates. Insurers may require medical exams before issuing policies. These processes help gather information and create a more level playing field. Governments and regulatory bodies often step in to address information asymmetry. For example, financial markets require companies to disclose key information to investors. Real estate transactions require full disclosure of property conditions. These regulations help protect less informed participants and promote fairer markets. Technology has transformed the way information is shared in markets. Online reviews, comparison websites, and data analytics have reduced information gaps. Buyers can now research products, read reviews, and compare prices with ease. This increased transparency helps create more efficient and competitive markets. E-commerce platforms have made information more accessible than ever. Sellers and buyers can rate each other, and product details are widely available. This transparency helps reduce information asymmetry, making online markets more trustworthy and efficient than many traditional markets. Peer-to-peer markets like ride-sharing or home-sharing platforms rely heavily on information sharing. User profiles, ratings, and reviews help build trust between strangers. These tools reduce information asymmetry and make peer-to-peer transactions safer and more reliable. In healthcare, patients often know more about their symptoms than doctors, but doctors have more medical knowledge. This two-way information asymmetry can complicate diagnosis and treatment. Effective communication and thorough medical records help bridge the gap and improve outcomes. Product warranties are another way to address information asymmetry. When sellers offer warranties, they signal confidence in their products. Buyers feel more secure knowing they are protected if something goes wrong. This helps build trust and encourages more transactions. A strong brand reputation can help overcome information asymmetry. Well-known brands invest in quality and customer service to build trust with buyers. When consumers recognize a brand, they feel more confident about their purchases, even if they can't inspect every detail. Expert reviews and third-party certifications help reduce information asymmetry. When independent experts evaluate products or services, their opinions provide valuable information to buyers. This can help consumers make better decisions and increase overall market efficiency. Many markets have disclosure requirements to ensure all parties have access to important information. For example, public companies must share financial statements and real estate sellers must disclose known defects. These rules help level the playing field and protect less informed participants. When information asymmetry is severe, it can lead to market failure. This means the market cannot efficiently allocate resources and both buyers and sellers may lose trust. In extreme cases, the market may collapse entirely, as seen in some financial crises. Trust is essential in overcoming information asymmetry. When buyers and sellers trust each other, they are more willing to engage in transactions. Mechanisms like reviews, warranties, and regulations all help build trust and reduce the negative effects of information gaps. In global markets, information asymmetry can be even more pronounced due to language barriers, cultural differences, and varying regulations. International trade relies on transparency, standards, and trusted intermediaries to reduce information gaps and facilitate smooth transactions. Digital transformation is rapidly changing how information is shared in markets. Blockchain technology, for example, creates transparent and tamper-proof records. This innovation helps reduce information asymmetry and builds trust in digital transactions. While many tools exist to reduce information asymmetry, no solution is perfect. Regulations can be costly, and signals like degrees or warranties can be faked. It's important to recognize these limitations and continue seeking better ways to share information in markets. Looking ahead, technology will likely play an even bigger role in reducing information asymmetry. Artificial intelligence, big data, and real-time analytics promise to make markets more transparent and efficient. Staying informed about these trends can help both buyers and sellers succeed. To sum up, information asymmetry is a powerful force in markets, shaping everything from prices to trust. While it can lead to problems like adverse selection and moral hazard, there are many ways to address it, from regulation to technology. By understanding and managing information gaps, we can create fairer, more efficient markets for everyone.